Why can't I see that you said yes? Oh, there it is. I hate this chat window. It's so annoying. So it's like so ridiculous to try to use this thing. All right, anyway, time to get started, so we may as well. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed and tracked are monitored, and virtual trading accounts, virtual account prices, and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential reward of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right. Well, first one back since Vegas, so let's see what goes on. Although the Vegas seminar went very well, actually, I thought. Okay, good. I'm not using my headphones. When I was in Vegas, I'm using the laptop without my headphones, and it sounded fine. Everybody's happy. So I said, why do I use headphones at home then? Makes no sense. I've got this nice Beats audio on my HP, so I think it should work out all right. Let's see. We're now going to share our desktop, and I have no idea what screen is going to come up. And it's the WebEx screen. Very good. Okay. Whoops, here it is. Reopen the chat box. Good. All looking good so far. And let's see how the market flows. There we go. That's a better view. Now, we were doing copper today, but that wasn't working out, so we got out with a very small profit, 37.50. It stopped out when it got up to, gosh, what was it, 3,005. You know, we barely made it. We were hoping for 301, which would have been a nice profit, but it only got up to 3,005. Way down there, very sad. And I even didn't even get in on $3, so I got only a 37.50 profit on my whole trade. Very boring. The S&P, though, ooh, look. The S&P, I took my first short here at 2,048. So I'll take another one here if we can get it. See if it fills at 2,04975. Maybe I'm being greedy, but we'll see. And we're just hoping for a little rejection here. When you're hitting the red line on the NASDAQ, you're hitting the red line on the S&P. The 1175 was kind of the reject line here on the Russell. And what did I throw away here? We'll go back to the Dow. We'll forget about copper now. It's a dead trade. And the Dow is not, the Dow's lagging actually, but it always lags. Oh, look at that, we got the fill. But we expected to get rejected here at 2,050 for the high. So now we're in an average 2,04925. And theoretically, I should get two more here at 2,050, and that would bring my average up to maybe 60, 70, whatever. But let's see how it hangs. We'll see what happens. So I got two for now. Always with the webinar, I get in trouble because I'm not paying attention, and then all of a sudden I lose a ton of money. So I'm trying not to do that. Can't really afford to lose a couple of $1,000 every time I give a webinar. Let's see what else is exciting. Not too much in the futures. Let's look at the other charts. Now, why are the futures going up? That's always a good question. We don't know what's going on exactly. I don't see anything particularly driving them right now. Just refreshing my news so I can take a quick look on my other computer. Iron ore market gets worse. Nothing in the last hour or so. Just a note on the iron ore market getting worse, because it kind of cracks me up, because I mean you hear constant negative news on the global GDP front. There's just constantly something bad happening, and you get more and more reinforcements like, oh, that's bad too, and oh, that shows the economy's slow. Meanwhile, everything just chugs along, not a care in the world. Everything's making new highs. So it's a little bit crazy this time. That's why I kind of like going to cash, though. It's like, look, I'm not going to pretend I know what's going on. Say, I don't know. I don't know what's going to happen right now, because things are just crazy stretched for no good reason. So it's a good time to be in cash and just watch and see what happens. You don't have to play all the time. Actually, it's funny. I have a shirt. I have a shirt that says, "If I can't win, I don't play." And that's my wife got me that, because I tell him about games a lot of times. So I was like, I like playing games I can't win. I like to play. I don't have to play games I only win, but I like to play games at least I have a chance of winning. I don't like to play if I have no chance. It's not like I'm not gonna play jump rope with my kids competitively, because I would kick my ass. It's no fun. I think that goes for the market too. It's like, why play? Why take good cash and put it into the market if you can't win the game? You have to at least think that you have a better than 50-50 chance of winning. Otherwise, you're just gambling. And so if you don't know what's going to happen, if we don't know what direction the market's going to go, we don't know which things are going to go where, we don't understand why something's going up, then it's not a good time to play. Play when you can see clearly what's happening. Play when you've got a good premise and you can see what's going to go on. There are certain things we like. I pointed that out this morning. In fact, I made a couple of good comments this morning, so let's take a look at that. We'll talk about what we've been doing in chat. Is today Tuesday? Yeah. Okay. I'm lost. Still adjusting back from my vacation in Vancouver City. Takes me a week to get myself back together. All right. So what did we talk? Oh, so right in the Morning Post today, we were talking about just the gist of the markets, and this bothered me a lot. The fact that, okay, I mean, look, when declining shares outnumber advancing shares, here we go on the Nasdaq, almost 2-to-1 on the Nasdaq. Declining, and 50% more here, 50% more there, 30% more there. When you have that kind of discrepancy, you got to think something's wrong. Most stocks are going down. Don't care what the index looks like. This is the S&P, but it's weighted. So 4 or 5 stocks going up can make the whole index look like it's going up, even when half the index is failing. So you got to read into these numbers. You can't just take things on their face value. The Dow, as noted by Dave Fry, is a completely pointless index. I mean, any one stock can knock it up and down by a mile. But it's not stretch, because we go back to the big chart. Here's the big chart. The Dow is actually, right back here. It's so far behind the S&P and NASDAQ that it's got miles to go. If these guys are right, and they're off in space now, if they're right, then these guys all have a lot of catching up to do. But look at the NYSE. See, today, where's the NYSE now? 10,947 on the NYSE. It can't get back over 11,000. It's a really critical line. So if it can't get over 11,000, then what the hell are the rest of these indexes doing? The NYSE is everything. I forget the numbers. 5,000 stocks in the NYSE, something like that. It's everything. It's the whole market. It's a much better cross-section. It includes all the big stocks. It also includes all the small stocks. It's the actual market. So the actual market can't get back over its must-hold line. The Russell, which is a 2,000 stock index of small-cap stocks, can't get back over its must-hold line. So the other guys are all narrowly defined. Like a couple of, the Dow, any single stock can take the Dow up and down 50 points by moving $6, $7. So any of the big stocks on the Dow moving 5% or 10% can make the Dow go up 50 points. So that hardly counts as an indicator. Then you got the S&P. The S&P has 500 stocks, But you know, look, if the top 10 stocks on the S&P are like 25% of the index. So again, you know, it's like if Apple and a couple other stocks go up, the S&P is going to go up with it. Then you've got the NASDAQ, which is completely ridiculous because the Apple itself is almost 20% of the NASDAQ. So what kind of indicator is that? So what do we have? We have Apple has gone up to, what are they today? Apple's at 115. Holy crap. So Apple's at 115. And that's up, where are we? Where are we in the week? Apple, Yahoo, somebody, there it is. Oh, just so happens to be on Apple. How kind. Look at this. So Apple is up 15% since, that must be October 15th. So in 1 month, basically, oh yeah, it's a 1 month chart. In 1 month, Apple is up 15%. So we take 15% of Apple, get a handy dandy calculator, and we say, okay, well, if Apple is, let's say conservatively 17% of the NASDAQ, then you've got a 15% move in Apple times 0.17. All right? So that's a 2.5% move in the NASDAQ is due to Apple. All right? So now we look at the NASDAQ, QQQ, over the same period. And the NASDAQ has gone up from 94 to 103. So it's gone up like 9%. So maybe about a third of the NASDAQ's move has been because of Apple. And I think we can do a comparison here. We can go Apple, All right, so Apple's up 15%, NASDAQ's up 9%. You figure like almost 3% of that, 2.5% of this number is just the Apple move. But then when the Apple moves up, the Apple components, the little satellite companies that feed off of Apple go up as well. So, you know, the suppliers and such, and then, of course, other retailers and so on and so forth. So Apple brings a lot of stuff with it also when it travels. So a lot of this pull, it's exaggerated. Where would the NASDAQ be? Without Apple, it would probably be down around here at 5%, which would be a pretty normal move. But when the NASDAQ goes up, then the S&P goes up, and everyone starts going up. So now I put on the S&P and see how we're dragging. Apple is part of the S&P, so Apple gives the S&P probably, Apple can't be more than 4 or 5% of the S&P. So probably if Apple goes up 15%, you probably get about 1% or so of this move is thanks to Apple. So you're down 6% for the S&P. So, you know, about 5–6% for the NASDAQ and the S&P would be about the right number. So the Dow is down here. Dow's in the same place basically. I guess I can't move that, but if I take away the S&P. So the Dow is also where the S&P is. But look at the NYSE. So now if we put in the NYSE, they don't really want they don't have that. They're not weighted like that, so they don't have that problem. They are at 6%. So 6% is probably an accurate move. Let's see if the Russell's also at 6%. And the Russell's at 6%. What an amazing thing. So you see that because, which is the Russell? That one, 7%. So you can see exactly what I'm talking about. In other words, you take out Apple, and you can judge where these indexes should be, and they should all be right about the 6% line here. So that's normal. And that means the other guys are up for not particularly good reasons. So although, you got to say also, though, if Apple's not going down, they're not going down either. So what's my premise? Is my premise Apple's going to go down? I don't see any particular reason for Apple to have a correction. Not right now. I think Apple should be at 120. Not necessarily today, but over the next reasonable period of time, they should be at 120. Long term, of course, 140. You know, if we go out to 217, I think 140 is probably an easy target for them. So how do we bet against NASDAQ? Well, I think part of it is, though, that if Apple settles down, then the rest of the components have to stand and fall on their own. Without Apple's boost, they'll start becoming a little bit of a drag. And that's how Apple will go down. If the rest of the S&P goes down, Apple will go down with it, even though it doesn't deserve it. Let's see, charts. Anyway, so we don't have any particularly bearish premise. I mean, there's just so much stimulus and so much action going on here. It's hard to say that there's anything that's going to take anything down. Let's see. We'll go back to the big chart if I can find it. There it is. So, I mean, look, logic says that when you make a move, here's a 5% line, 5% line. This is basically a 10% move from this spike down to this place here. That is a 10% move in a month. That's the reason you think there's going to be a correction, just because markets don't move 10% a month. Here's a 10% move. In fact, this isn't even from the spike. This is from the must-hold line where we actually did form a base, which is encouraging. That's a bullish sign, forming a basic must-hold line. Then going all the way up to 10%. These are channels that you expect to be in for months. And in 1 month, it crushes the channel. That's not normal. So what would be normal now is a pullback to this 2.5% line. Basically, on the 5% roll, it's a 20% pullback, right? But then with an overshoot, you get 2.5%. So you look for a 2.5% pullback here. That's going to be a strong, after a weak retrace of 20% of the run. 20% of the 10% run is going to be 2% back to 2,000. If 2,000 fails, then you're almost certainly going to see 1950 again. All right, so that's what we're going to watch out for on the S&P here, okay? We're going to watch out for the correction to start, and I expect it to start right now, which is why we currently have these two shorts. Whoa, 2050, damn it. So much for that. But I expect it to start right here. Here we go. And let's put, oh, it wasn't quite there. It did top out exactly at our stopping point, though. So I think I'm going to get a fill if I sell this. Maybe. You see how cheap the S&P is? Listen, it's not really expensive if you're wrong. It's not a big deal. It's just fun to establish a position. They're very inactive things. Obviously, the Nasdaq's already dropping off there. So, see, and this is what I mean by short and the laggards, too. If these guys are all dropping, then who's the laggard? Right now, it'd be the Nasdaq and the S&P. It's still sort of testing their thing here. And everybody else is falling. Now, you want to watch the Russell carefully on this line on 1172. If they can't hold that, that's going to be a good sign that the rest are going to start following lower. This is the easiest way to play the futures. Just watch your horses. They're all going to go around the track. They're all on the same track. So it's very hard for one of them to sort of like go off to the side. So generally, they're going to go in the same direction. Does anybody have a question or a comment? Am I talking to people? Because the last thing I see is Chow says, sounds good. That's the last comment I see. Hello? Anybody? Come on, these things are supposed to be interactive, people. Maybe it's not working. Yes, Jim? Okay, at least Ivan's there. Me and Ivan are going to have a chat. I mean, really, guys, ask questions. Okay? You know, it's like, otherwise I have no topic. I'm like just drifting around. So where was I? I did have a topic, but I forgot about it. Nothing's going to happen. It's, you know, we're into holiday mode on the markets. Nothing's really going to happen. That's why I just wanted to like say let's kind of cash out and forget about it, because we can go up, we can go down. There doesn't have to be a reason. There doesn't have to be anything going on. It's just the end of the year. It's time for, I mean, look, people who are in the markets generally have done pretty well this year. So if you've done pretty well, it's a good time to like take your money and go shopping for Christmas gifts. Where are we? Okay, so yeah, we talked about the Russell. Oh, so that's the thing about cash. It's not that there's nothing to buy. Here's a really nice play on Taser I had from this morning. Okay, we have these, we have the bull call spreads. You can do that. In fact, this spread here, even though it's doing well, is really only net $1,000 as of this morning, and it still has a $7,000 payoff at the end. You still make $6,000 bucks, and all Taser has to do is hold 20. So, you know, when you've got cash on the sideline, you look at a trade like this and go, hey, I'll take 1,000 net of my cash, and I'll put it into this trade, and I'll get 6 back. That's not a terrible use of your money when it's sitting on the sideline. And you don't have to do a lot of it. You know, it's like, in other words, one trade is going to make you 600%. And let's use the hard number. Okay, so you put 1,000 into this trade, about 3,000 in margin, and it's going to make you $6,000, right? Profit, if all goes well. So in other words, what's the point though? The point is you don't want to miss out on a bullish market. That's what you're worried about. I forget what I was talking about too this morning. Somebody we were talking about, like, well, you know, whether he's like, oh, I don't know, I don't want to let go of my positions, this and that. I'm like, at least cash half out, at least take some off the table. If you're in these positions that are doing so fantastically, it means there's profits to be taken. So take some profit, get some cash on the sideline, and let's say I cashed out half of a $100,000 portfolio and I have $50,000 sitting on the side, right? So how much would I be missing? Am I going to miss a 20% rally in the market because I took $50,000 on the side? So if I'm going to miss a 20% rally at $10,000, all I have to do is take 1,000 of that 50,000 cash, put it on this trade, and I get 6,000 back. That's a 12% return on my $50,000 on one trade with $3,000 in margin and $1,000 in cash. That's what you do with cash. So if the rally is real and the market keeps going up 20%, the rally I'm worried about missing, that I'm fantasizing that I'm going to miss. If it goes up, first of all, I still got half my money in the portfolio, so I'm going to make $10,000 on that side anyway. The $10,000 I'm going to miss on this side, all I can do is make a couple of stupid bullish trades like this one, not stupid, because like, you know, crazy bullish, high payout sort of thing, and I'll make it again. This is 3,000 in margin, 1,000 in cash, and you make 6,000 profit on the trade. Do two trades like that, and I'll make more money on this on my cash than I'll make on my fully invested portfolio that makes 20%. I think that's a problem. I picked up that problem from a lot of people. The people don't understand 20% is a lot. You know, this guy wrote me a note the other day, and he says, oh, I was up 50% at some point this year, and then I blew it because I got greedy and I gambled. It's like, I don't understand. Why would you gamble when you're up 50%? 50% is gigantic. If you're up 50%, let me look at this. If you have $100,000 and you get up 50%, you have 150,000. You get up another 50%, and you're at 225. You get up another 50%, and you're at 337. You know, if you get 50% and you don't lock that in, that's crazy. All right. And by the way, in our short-term portfolio, we were up 100%. We should have cashed it in, frankly. Because the reality is, you know, now it's up like 70%. It's not horrible. But I'm just saying, the point is, when you're up 100%, that's so unrealistically good that you can't expect it to last. And you know, the reality was the short-term portfolio protects the long-term portfolio. So I didn't really want to take it off. But if you think about it, taking $200,000 and going to cash, essentially the $100,000 of profit in cash that we had, that was a hedge to the long-term portfolio. I don't need to keep the short-term portfolio invested to have a hedge, do I? I got $100,000 cash as my hedge. Cash is nice. And you know the difference was when the long-term portfolio bounced back, we wouldn't have lost the $30,000, right? We'd have $100,000 cash still. So I have to think about that for next time. So speaking of portfolios, let's see where we are. I'm not sure if this is updated. The income portfolio, speaking of cash, we finished, as everything is now done, it ended up at 15.8% for the year. That's, again, they talk about 50%. Our goal was to make 10% in the income portfolio. It made 15.8%. That's even after fixing GTAT and accounting for all that crap. You know, we closed it, said it was up like 20% when we closed it, but when we took out the GTAT loss and everything, it ended up at 15.8. That's probably loud on camera, on the mic. Let me think. So that's cash. And that's not cash because I want it to be completely cashed out. In particular, it's cash because rather than going half cash and paring it down and so on and so forth, we decided it's kind of redundant. So going forward, we're just going to sort of track the long-term and the short-term portfolios and not flip back and forth. Because there wasn't a clearly defined purpose to the income portfolio other than it's a bit more conservative than the long-term portfolio. Just for review, the $25,000 portfolio is probably crappy. Let's see. Oh, 10%. Okay. So that's down. And what do we have here? We have our long on BTU. I feel good about that. Long on USO. I feel good about that. Long on Yahoo. Feel great about that. We have these DXDs not working out. Okay, we're not getting that sell-off in DXD we expected. CMG is a disaster. It's already showing 0. EWJ, it was doing good for a minute yesterday, and now it's back to 50, so that's okay though. And GMCR, another disaster. That's very expensive actually. And we're waiting for earnings tomorrow, is it? I think earnings are tomorrow on GMCR, and we'll see what happens. But these are probably going to be a fail. I mean, even if they drop 20%, it's still going to be $127. Or 120 something, let's say 125. 125 is barely going to help in this situation, so we're pretty screwed there. Had it not been for this loss, we'd be in very good shape on this portfolio, but it was for this loss, so we can't help it. Butterfly catching. This is really our most conservative portfolio because we're always hedged. We're hedging everything. Everything is hedged against everything else. Butterfly portfio's not really going to review it right now, but we're up 18%, which is normal. You know, we're usually up 18% or around there, and just sort of drifting along. The key with the Butterfly portfolio, especially this is a building year, what we do is every time we get up to around 20%, we add another position. Every time we add another position, it's expensive because all the bid-ask spreads on these things are kind of nasty. So it gives you a bad look in your portfolio. But what does improve every month is our ability to sell more and more premium on a regular basis. And as that builds, and as we have, what do we have now? We have 1, 2, 3, 4, 5, 6, 7 positions. So as we get to like 10 positions, 15 positions, and we're constantly, I mean, no matter what happens, there'll be tons of premium sold every month. That's when the money really starts rolling in. But you got to build it over time. You can't just jam in a bunch of positions. I mean, first of all, if you jam in a bunch of positions, the bid-ask spreads alone on your portfolio will make it look like crap. Second of all, you're not building up the cash in your account. You know, because look at this. We have $73,500 in cash left in this account. We're using no margin. No margin. Because everything is covered. We're using $73,500 in cash. I mean, I'm sorry, we have 73, so we're using $26,500. And don't forget, the real buying power on this thing is $200,000. You know, in a normal margin account, you have $200,000 in buying power. We're using no buying power at all, 10% of our buying power for this portfolio. And our return, I just want to make this really clear to people, our return with $73,000 cash on the side, using $26,000 of cash, of margin out of 200,000, using 10% of our margin, we're making 18% on the whole portfolio. Okay, so our profit is what? We're at so we're at 117. So we've made 17,000 on the 23,000. I'm sorry, 26,000 we put to work. So the profit on these positions is humongous. But we just haven't built up a lot of them yet. We're doing it very cautiously. And you know why we're doing it cautiously? Because that's the way you do it. Because you do it cautiously because there's no point in rushing into anything. There's no reason to rush into these things because this will, over time, generate a fortune. And so you do what we call the planting trees. You know, this is that man who planted tree stuff. You put one down, you let it grow a little bit. You put another one down, you let it grow a little bit. You put another one down, you let it grow a little bit. You don't put them all down at once. You don't use all your seeds up at once because what if there's a flood? Then you're screwed, right? But as these physicians get older, they go deeper in the money. They make more and more money. Like some of these have turned into 2017s already. The OIH back in 2017. That's the only one so far. But some of them we rolled to 2017, and some of them, you know, so we start these positions, we push our longs back, and we get into bigger, longer, safer positions, and we just start churning and churning the money out of these things. But, yeah, I think that's important to make clear, because I had a conversation with somebody about that in Vegas. It's like, you know, it's 18%, but it's 18% of nothing. It's 18% of the entire, I'm sorry, it's 18% of the entire portfolio, but we're only using a tenth of the portfolio to make that money. And that doesn't mean we should run out and use 50% of the portfolio right away, because these are all tricky positions, and you've got to get better at managing them. You've got to get used to watching them. You've got to understand the ups and downs. But this is the greatest freaking system in the world to play. You're just selling premium, selling premium, selling premium. Anyway, so let's see. We do have some questions now. So Pat says, I was checking the Walmart fly, long position, 1680 calls to be rolled to. We just rolled the Walmart. I don't think I'm inclined to do that right now. $80 calls. These calls? Okay, so we have these short calls. I don't know why you're saying 16. They're not 16s. We have these calls. We already rolled those calls, you know. Yeah, maybe you missed that. Okay, so like, when do we do this? I think we did this last Thursday or last Friday. I think one of those days. I think it was last Friday. I'm sorry, Thursday. Last Thursday, I think we did the butterfly adjustments, and let's see, what day was the 13th? 13th was Thursday, right? Because he thinks from the 13th on the board. So, so last Thursday we did the butterfly adjustments. And this was, so take a look under the Thursday post and you'll see our adjustments to the butterfly portfolio. But this is where we ended up. So if you look at the Walmart, we did do it. You're right. So in other words, you're correct then, because we did roll. But what we decided to do, because our 80 calls were so, they were so on the money, that we decided to take the money off the table and roll up to the 8750 calls. We didn't really feel the need to go out to 2017 yet. We're not sure where this thing's going to go. And also, if you think about it, 2017 don't provide you as good a protection, because they're not going to move up and down as fast when Walmart goes up. So I don't think Walmart's going up much further than this. In fact, we rolled our short call pretty much straight, you know, across to the 80s, because we didn't think it was really going to stay above 80 for long. But joke's on us so far, because it keeps going up. So we shall see what happens. But your instinct is right to do something about it, because you made so much money on the long call. But in this case, we decided to take the money off the table, roll up to the 8750s, because Walmart's already at 84. Okay, Craig says, why are REITs up so much? REITs generally going to respond to the expectation of long-term interest. So the expectation of long-term interest, thanks to the Fed speak from last week, is that we're not raising rates anytime soon. And that's a relief for the REITs. They have cheap borrowing costs. It's good for their cash flow, so on and so forth. That's all they are. They live in fear of interest, basically, which is a misplaced fear. So they don't really get hit that badly for interest. Well, I take that back. Some REITs are poorly managed and get whacked when interest is up. Good REITs like NLY, AGNC that we like to play, they tend to, and CIM is NLY's management too, they take advantage of changing rates and they restructure, and they're usually way ahead of the curve. Good management teams know how to play that game. You know, and none of this is surprising. I mean, it's not rising rates that hurt a REIT. It's a surprise rising rates. When the Fed tells you 18 months ahead of time we're going to raise rates, these guys have all the time in the world to restructure their loans and lengthen their term and take advantage of some long-term capital, so they keep their borrowing costs. As long as your borrowing costs are lower on the average than the current borrowing costs, you have an advantage in the market. You don't need to have, they're not running back and forth. A good REIT isn't running back every week to the bank to get this week's rate for the next 3-month loan. They're not doing that. They're taking long-term loans. And It's one of the things people don't say about the builders either. Like builders, a good builder like Hovnanian, they're taking a huge amount of cash right now. Their borrowing costs are going up, and their borrowing costs are going up because they're like, it's cheap now. It's cheap now, so we're going to buy a whole shitload of land, and then when the land gets more valuable, we're going to start building things on it and selling it. You know, they're taking advantage of a down market. This is what you want people to do with your money. Yet people run away from these guys when they spend money in a bad market. It makes no sense. The Bank of Japan. I don't know. We went through this already, didn't we? In the 90s, with the Bank of Japan buying up all the property. Actually, China's coming in and buying up a lot of U.S. property. And you know, and by the way, when you say China, it really is China. You know, most probably half of the Chinese corporations are state-owned corporations. So you know, when a Chinese company buys something, it's generally the country of China is buying your land and buying your companies. And they're all supported by the country anyway, so it's a tricky situation. Not all REITs are the same. You like AVB, and they pass the cost to the tenants. Yeah, well, that's even better though. When you pass the cost along to your tenants, and you've got, you know, you're sitting on some long-term money that's cheap, and you're passing along the rate increases anyway. Yeah, but that's the point though. If you're smart, you make more. You get more than the market will bear because you wisely took your long-term loans at 3%, and then when rates go up to 5 and 6 and 7%, or your competition is forced to raise rates, you can raise rates but not as much and make a lot of money. So yeah, I'd absolutely rather have a REIT, especially those commercial REITs. You're right, those long-term investments when you're leasing your stuff to like good commercial real estate, not just crappy malls and things like that. It's freaky how it's really weird how many malls have gone out from space. All right, let me check on the market, see how we're doing while I'm looking. And I'm just about even. So I have 3. So what's our rule? Generally, the rule is that when we get even, this is how you scale in and scale out. When I get even, I'm going to buy one back. So I start reducing back to my 1x position. But my 1x position is now at a higher strike than I could have otherwise gotten it to. All right, and we do have the Russell. It did break down as we expected it to. We have this over here. We have this over here. So I'm going to keep the 2x probably, but I do want to just catch that so I'm back. So that becomes my new basis for 2x. So if we do go higher, then I'm a little more willing to add a little bit to my ladder. What else are we doing? Oh, yeah, back here. Okay, I'm sorry. So that's the butterfly portfolio all sorted out. So again, I just got to emphasize how, you know, we talked about it. I mentioned it that it's safe, and I realized when I talked to somebody in Las Vegas, they didn't quite get the concept of what I mean by safe. I'm like, you're all in cash. You can weather a massive storm in this portfolio. You're all in cash. You have the ability to sell incredible amounts of premium every month, and you're just building this base that lets you, it widens and widens as time goes by and lets you sell so much stuff every month. It's fantastic. Craig says, when the stock moves up half a point, do the calls also move up approximately half a point? No, there's not really a direct relationship like that. Deep in the money calls, yeah, it depends on, you got to look at your deltas. You know, any option is going to have a delta. So if you got a, chat box that way. All right. So with Apple, if you got the, it's at 115. So if you have the 105 calls, their delta is 82. So you're going to capture 82% of any move. So 5% would be 4%, right, on this one. If you're in the Apple 120s, they've got a delta of 34. So if Apple moves up 5%, they're only going to move up 1/3 of that, or 1.5%. See what I mean? So that's you got to, you know, that's the delta. That's how you think of the delta. It's a relative modifier to how much that position is going to move compared to the other. Oh look, they hear that. I don't know if you heard that beep, but that was my thing filling. So back here. All right, so we came down to that level. It didn't last apparently. Went back up, but now I'm down to 2 positions. And my average is right here at 49, well, just 4987. Oh. I don't know if I trust that thing. But it says my average is 4987, so I'm pleased about that. And it seems to be, it tells me I have a profit at this spot. So All right, so that's good. So we started down here at 4.9, and by selling one and doing a ladder and selling another and selling another, we raised our basis, and now we got out and we're back to 2. If it wasn't such a cheap futures to play, I wouldn't want 2 contracts. I would want 1. Like Rosie Russell, I'd probably want to be back to 1. But on the S&P, who cares? It's like only what is it, $50 per point or something like that on the S&P. So it's not a big mover compared to the other guys. So I'll kind of hang on to 2 for the moment. And also, as long as we got the good signs, because what do we know now? I'd say there's almost no way this is going over 2050 unless these guys come back to their lines. Because it couldn't make 2050 when these guys were over their line. So how's it going to make 2050 when they're under? So that means I could feel pretty good about my short position here, right? In fact, if you want to add one, this is a good entry point. Because these guys are falling, all 3 of them are falling. Now the laggard is basically, see, the laggard is no longer. The NASDAQ caught up. Remember we were talking about it being a laggard before? Now the NASDAQ's catching up. So the laggard is still the S&P, and the laggard is the Russell over here. I'm not the Russell, I'm sorry, Dow. All right, but the better line, if I have to choose, the better line to short on is this 2050 line, the big fat line. It's, you know, 2050 is going to be resistance on the S&P, and you also see 2050 is the the resistance 2 line going up. That's like a double whammy. That makes it really hard to get back over. All right, so hopefully that'll hold out. I think the only way it's going to break is if these guys come back. So we'll see what happens. I'll leave it for now. Where were we? Oh, yeah. No, don't start a new window. Shoot. One direction. All right. Let's see. So we were talking about Taser, right? And that's a good thing, and that's a fantastic position. So when you have cash, there's tons of stuff you can buy. You don't need to worry about, whoa, I have cash, that's terrible. It's not terrible, it's great. It means you can start looking and hunting and finding deals and seeing cool stuff. Very, very important trade we did. Here it is. We have this ABX, another fantastic trade. So ABX, we're looking at, now it's up to 13.11, having a 5% day. Now, we are concerned, we were just talking about this in chat, we're kind of concerned that the only reason gold is going up is because there's rumors that the Swiss National Bank is going to start backing their currency in gold. If they do that, they're going to need a lot of gold, and that's going to raise the prices. If they don't do that, then this is just a rumor and gold can continue its downtrend. This is a good V, though. It's a pretty good V pattern. Made a nice little base, and now it's popping back up pretty sharply. Very important. It gets past this, move this little line at 14. It's a something average, 50 something average. Who knows? I don't know if it's days or what. It's probably days. But we have this average here at about 14. We want to see it pop through there and hang out around here and consolidate. Would be lovely. Don't really want it to fly right back up, but it'd be nice to consolidate over here. And just this morning, we were listening to this ABX trade. Look, you can sell, and again, it's hard because everybody freaks out because, you know, they say, oh, it's just lower than 11. It was just like $10 almost ABX. I don't care. I think it's worth $10. So I'm going to sell the 2017-13 puts for $3. And then you buy the 2017 10-20 bull call spread. So it gets 2 years. They have 2 years to get to 20. And if that happens, your net 20-cent trade, so you're tying up 20 cents of cash, goes to $10. But you're starting out $3 in the money. It's a 10-20 spread. So all ABX has to do is flatline, and you turn 20 cents into $3. Now your margin is probably about $3 on this thing. Did I write that? I think I did right there. Yeah, it's 3,000 in margin. So your margin is $3 on the trade. But again, that's the point. If you're in cash, what do you have? You have a ton of margin. It's sitting around doing nothing. So again, it goes back to that example before. I said I take $1,000 of cash and a couple of thousand in margin, and I throw it into that rig. What was it? What the hell trade was that? It wasn't rig. I don't know. Whatever that trade was we were looking at before. And here you take zero cash, like a few $100s in cash, 3,000 in margin, and put it into here. You're still sitting on your cash. Your worst case is you're going to, oh, Taser, thank you. You're still sitting on your cash. Your worst case is you're going to use some of it to buy something, which is what you do. You know, you're whining about like, oh, I don't want to be in cash. I want to be in a position. Well, here's a position. You'll be in it if all goes badly. If all goes well, you're going to get $10,000 for nothing. So now we've already in 2 trades, in the Taser trade and this trade, you get $16,000 back in profit on 2 trades by putting $50,000 at the side. And what's your commitment? Your commitment is only 1,000 shares of Taser and 1,000 shares of ADX. So you'll tie up $30,000 of your $100,000 buying power. But meanwhile, you're in cash. You're not doing anything with your buying power. You're not using any margin. You have a million ways to be flexible with it, and you're not tied up in a dozen positions that you used to be tied up in. Where's the problem with this? This is a good thing. All right, so there's always an idea. I mean, Keith, when do we not have an idea to trade something? It's the thing is you have to realize that if you've got positions and you already made 20, 30%, you're probably not going to make another 20 or 30%. You've got a much better chance of making 20% by buying new positions that are beaten down, that are in better shape. It's like, yeah, I love Apple, but you know, we've been in Apple since it was like $70 relatively from the last cycle. I mean, before that, we were in it since it was like $10. But realistically, the latest cycle of Apple was at $70. 70 times 7 is $490. Yeah, so about $500, $450. We were like heavily buying Apple again, and so now it's $450. Now it went from 70 to 115. All right, and yeah, I think it's going to go to 140. But you know what? 70 to 115 is 45. 115 to 140 is 25. It's slowing down. Even if it's going up to 140, that's still slower than what we made before. So maybe I need a fresh horse. That's all it is. I love Apple. It doesn't mean I don't like Apple. It just means that it's getting tired. It's had a huge run. And it's not, and getting tired is like a weird thing to say about something you expect to go up 25%. But, you know, hey, 25%, we can do better. Certainly do better with ABX. If this thing doesn't make 25% in 2 years, I would eat my hat. I mean, that's just crazy. All right, then BHI we looked at. Now, the BHI is interesting because BHI is it's an arbitrage play because Halliburton offered them $19 in cash and 1.12% of Halliburton stock. Halliburton stock is $50. So $50 times 1.12 is $56 plus 19 is $65.75. So the net offer on BHI, these guys got it right. And you see this, when you see a spike like that, that usually is the exact offering number. You'll usually see some idiot spend whatever is offered, somebody jumps right in and buys the stock for that price. Makes no sense because that's what's offered. Now the assumption, of course, they're making is that, well, if that's the initial offer, it should get better. It's often true. Sometimes, though, they look at the books and it falls apart. But what I like about this deal with BHI is that Halliburton has agreed to a $3.5 billion breakup fee. So I don't want Halliburton, because if the deal goes through, they're screwed. They got to hand over $3.5 billion in cash, and they don't have their deal. But I do want, and this is why Halliburton shareholders get upset. They get out because they're like, what the hell did you do? You pledged $3.5 billion to these guys, and you're going to buy them for this ridiculous price? They were at like 50. They were at 50 last week, and you're buying them for 75. That's just nuts. So the Halliburton people are pissed. They're leaving. Now, to some extent, though, since they're offering 1.12 Halliburton to make their price, if Halliburton drops much below 50, then they're going to have to renegotiate this deal and offer more Halliburton. And if the only reason Halliburton's going down is because people are pissed about the deal, this is a double win for Baker Hughes. So there's all kinds of ways to win this. You win if the deal breaks up because Baker Hughes is back to where it was with $3.5 billion in cash, which is about a year's earnings for them. Let me check that. Off-the-cuff comments, I want to double-check my logic, but I don't think they earn much more than $3 billion a year. No, look at that. That's a year. They earn $1 billion a year. So Halliburton is saying, if we don't make this deal, we're going to pay you 3 years' worth of earnings. If I were Baker Hughes, I'd be like, please let the deal fail, because that's a lot of money. So Baker Hughes, they got a $28 billion market cap. They're going to get 10. almost 15% of their market cap from Halliburton if this deal fails. Don't you want to be a Baker Hughes shareholder? All right, so what's our position? We're saying that we'll sell the 55 puts, okay? And we'll sell these $55 puts for $4.50. That nets us in at 50, which I'm comfortable with. Oh, there you can see the 50. So, because generally you figure they're down here because of, you know, the oil price is selling off and all that. Same reason we're losing rig and everything else. I mean, they're down because the oil's down. So we figure over the course of time, oil will come back. So we're kind of okay with a $60 price tag on Baker Hughes. But we'll sell the $55 puts for $4.50. And then we'll take that $4.50 and we'll apply it to the $57.50, 70 full call spread. It's still within the range that Baker Hughes trades. It's all the way to 2017, and it's only $6. So we're going to net into that spread for $1.50. So basically, anything above $59 is a winner for us. All right, so from 59 to 70, we make 100% of the money. So we can make up to $11 on this spread for doing nothing. And the cool thing about it, though, is if the deal does go through, this is the key. If this deal does go through, we don't have to wait till 2017, because what's going to happen is all the Baker Hughes stock closes at the net price, which should be theoretically $75. And if this deal closes out at 75, we're going to get paid in full, our 57.50-70 spread. The puts will expire worthless, and we'll have $12.50 handed back to us for our $150 investment. That's a good play. You know, again, we're talking about, I don't know what it is, it's almost 10 times. You're almost getting 10 times back on your money. And we might not have to wait. This is the cool thing about it. We might not have to wait till 2017. So if the deal does go through as advertised, this thing pays 10 times. And that's after the deal's announced. Isn't that crazy? This deal's already been announced, and you can still do this. If the deal falls through, then you're stuck with Baker Hughes. But Baker Hughes plus $3.5 billion is a nice thing. All right? And believe me, Halliburton's not stupid. They're not offering Baker Hughes $3.5 billion as a breakup fee on a deal they aren't 99% confident is going to go through. And as we know, Halliburton is completely enwrapped in the government, so it's highly doubtful that with a Republican Congress and a Republican Senate that anything's going to stop this deal from going through. So these are gifts, but they're the kind of gifts that you take advantage of if you have cash. And because we have cash sitting on the sideline, we can do these things. In fact, I didn't even put this in one of our portfolios. We really should. I did send it out as a top trade alert, but I didn't put it in one of our portfolios, which I forgot to do. What else? Let me talk about something important. Oh, yeah. Let me talk about hedging. I knew there's one more important thing to talk about. QC asked if he's going for the holidays. So he says he's going for like 15 days or 20 days or whatever for basically a couple of weeks into the middle of December. So what to do for a hedge or to be, to protect his portfolio. So depending on what you have left, you have to say, well, how much am I going to lose if the market drops 20%? Because you want to be protecting against that. You can't really protect yourself against a 40% drop. It's just if you think the market's going to drop 40%, cash out now. Why on earth would you keep your money in the market if you think so seriously it's going to drop 40% that you need to hedge it? Right? You see the logic there? It doesn't make sense. Right? It's like fire insurance. Like I'm going to buy fire insurance based on a 1 in 100 chance my house is going to catch fire. Right? If I thought my house, if I live next door to the volcano that's the lava creep that's happening in Hawaii, and it was like 50 feet from my house and heading my way, I would have like an 80% chance that my house was going to catch fire, and I would probably make damn sure I had the greatest fire insurance known to man. But that would be because I can't sell my house. I can't sell my house because the person coming up my driveway might notice the lava creeping towards my house. So I'm stuck in my house, so I have to buy the insurance. But you know what? If I have the house that the lava is creeping up on, right, should I be buying lots of fire insurance, or should I be selling my house if I can get rid of it? Because I think my house is going to get engulfed in lava and be burnt to a crisp. So the solution isn't to buy fire insurance. The solution is to sell the house if such a thing is possible. Now with stocks, you're not stuck in the stock. You can sell it. You can go back to cash. Cash is liquid, flexible, and lets you do anything you want. You know, so it's like I don't know why people fear it. It's like such a great, cash is fantastic. In fact, I was just having a conversation with a guy yesterday I went to had dinner with, and he was saying how great cash is. He talked about all these deals he gets handed for cash. He's like, people come to me all the time. They know I have cash. And so because they know I have cash, whenever there's an emergency, somebody shows up at my door and says, oh, I need some cash. You know, I need some quick money for this, quick money for that. And he goes, and I get the best deals. He goes, I get warrants. I get kickers. I get extra interest. I get big. I get a piece of the business. He goes, I'm happy to lend cash in an emergency because it gives me such an incredible return on my investment. But you get that because you have cash. When the market crashed in 2009, the people who had cash were laughing their asses off. Because people were selling GE for $5. People were selling Bank of America for $2. You know, you could buy Apple for $85 at the time. That was crazy. I mean, $85 being effectively $10 now. You know, I mean, in the post split. You know, that's just nuts. There are so many ways to make money for people who have cash. The people who said, oh, I don't want to get out. The people who in July of 2008 said, I'm not getting out. You know, the market's doing so well, I hate to miss the next move up. Well, a month later, those people were down 30, 40%. And they didn't want to get out then either because they said, oh, well, hopefully it'll bounce back now. So I'm down 30, 40%. I don't want to get out. If you're not going to get out at the top of the market, when the hell are you going to get out? And you got to know that about yourself. You have to understand. And it's hard. If you haven't been in the market through those cycles, it's very hard to know how you're going to feel when it happens and know how you're going to react. And that's why really, I mean, you know, the discipline should be going to have cash. Whenever you're not positive that the market is going to be going up and up and up, whenever you have any doubt, go to a more cashy position. That's all. There's plenty of ways to make money with the cash. Short-term betting and smart betting like the ones that we're talking about today. You don't have to have tons of money tied up in positions. It's not important. They'll be there. You know, and speaking of that, we'll talk about the Apple position next. So where were we? QC. Right. So I said to QC on DXD Palisade had this idea earlier with a different DXD play, but all you got to do is take the January 23-25 bull call spread on DXD. All right, and I'll show you what that looks like. Oh, and back over. DXD. All right, so it's in November now. We got January. That's 60 days away. He's going away for 20 days, so it's 1/3 of his trip. He's going to buy insurance. It's cheap. And I said, what I said was 23.25. Is that the idea? So these are going to be about 60 cents. In fact, it is 60 cents, and these are 25 cents. So for a net of 35 cents, you get $2 of protection. All right, so if he puts $3,500 into the spread, he's going to get $20,000 worth of protection on his portfolio. And DXD, it's an ultra, so if the Dow drops 5%, this thing's going to go up 10%. 10% is $2, $2.30, whatever. So it'll be right around $24.50. Your goal is 25, but $24.50 is good money. That's $1.50 back on your 35 cents. All right, so anything more than a 5% drop in the Dow is going to give you a huge payback. Okay, and up to $20,000 on 3,500. Now, what's going to happen if the market is flat while he's away? If the market's flat, he's going to lose 1/3 of his premium. How much is his premium? Well, the whole thing is premium. It's out of the money. So of the 3,500, 1/3 approximately will evaporate in 20 days that he's away. But that's okay. So his cost of insurance to guarantee that he won't get burned for the next 60 days, for the next 20 days, I'm sorry, the cost is about $1,200 bucks. Now, if the market goes drastically up, he will lose probably more than his $1,200 because he's going to be more out of the money than he was. But you know what? That's okay too, because the large amount that he's protecting, he's got to be protecting. If you're going to spend $3,500 on a hedge that gives you $20,000 if the market goes down, you've got to have at least $100,000 worth of bullish positions. So in order for this position to lose money, then the market's going up, and that means his bullish positions have got to make 1%, right, which is $1,200. So it's going to offset his hedge. The idea is to protect. All right, so if the market goes up, he makes money on his longs. If the market goes down, he's going to make money on the short position. And if the market's flat, his cost of insurance is going to be $1,200. So you have known entities here. Everything is known. You can sit there. This is an insurance policy. That's all it is. But it's a very sensible one because it has a huge payoff in a short period of time if anything bad happens. That's the idea of insurance. All right, so let's take a look at that. Oh, I did it again. I can't believe I keep doing it. Go away one direction. All right. So that's DXD. And you can see how high DXD was on the channel last time we had a sell. It shot all the way up to 27. We were talking about 25. That's our payoff, right along this line. All right, so then back to the portfolios. All right, so we talked about the butterfly portfolio. Then we've got our long-term portfolio, and it's the same thing. So in other words, we do the same thing in a little bit more complicated manner with our long-term and short-term portfolio. Our long-term portfolio isn't complicated. It's just bullish. It's a bunch of bullish positions. They're up like, look at that, they're up 25% now. And again, we're using very little margin because now we've got a value. We started with 500 at the beginning of the year. Now we're up to 624. All right, so now we got 1.2 million in buying power. We're using 360,000 in margin. We're using 1/3 of our margin. So we're not using much of our margin. We've got a ton of cash. We actually have more cash than the portfolio is actually worth. That's kind of funny. But it's because we're being the house. We're selling premium. Everything we buy, we sell. We sell puts. Before we buy a stock, we sell the put. So the first thing we do is sell. Not the last thing, not the next thing. We sell the put first, and if we end up getting the stock, we get the stock. If we don't get the stock, we have the free put. So we've always got puts for sale somewhere. Not using any cash, collecting cash. Whenever we buy a stock, we sell puts and calls. Whenever we we either buy a stock or we buy a bull call spread where we're still selling, and then we sell some puts with a bull call spread. Those are artificial buy rights. We have either a natural buy right or an artificial buy right. Now, because we kill the income portfolio, we're going to start looking to convert more of the dividend payers to natural buy rights because I'd rather collect the dividends on these things. We just added AREX this week, Approach Resources. That was a nice little play. They're basically chopping along around this price, 11.45. I like this layout a lot. It's pretty much even. You can still get into it. 1,000 shares. We sell they only go to April, so we sold these are the April $10 puts and calls. Now notice the thing's at 11.45. We sold the $10 calls for $2.65. That's freaking great. That knocks our basis down from $11.50 to like $9. So there's another thing, you guys. It's very important to understand this. The concept like buying safety has value. So I got a stock here. It's $11.50. I'm buying the stock and selling a call. I get called away at 10. You're like, well, you buy it for $11.50, get called away at 10. Why would you want to do that? I was like, I want to do that because I still make a buck. This thing can drop more than 10%, and I still make a buck. I don't give a crap what if it goes flat or if it goes up. I don't care. As long as it doesn't drop more than 10%, I make a buck. Now, if it does drop more than 10%, if it drops all the way down to $10, I'm also selling the puts. But you know what? I get $1.20 for the puts. So now what happens? So my basis has now gone from $11.50 okay, so you got $11.50 minus $2.65 $8.85 is my actual net. So I'm going to get called away at 10 because I sold the $10 calls. So unless this stock drastically falls, I'm going to get called away at 10, and I'm out of it. But you know what? I'm out of it with a I'm sorry, but that's not my net profit, though. I also sold the puts because I said, you know what? If this thing's below 10, I'll even buy more. And I sold those for 120. So now my net is 765. Okay, so I'm netting into this stock. It's an 11.50 stock. I'm netting into it for $7.65, and if it's at $10, I get called away with a what? $2.35 profit, right? So $2.35 divided by $7.65, 30% in 6 months. That's what you do with cash. Because if you're making 30% in 6 months, that's 60% a year. And if your goal is to make 20%, what does it mean? It doesn't mean you take your whole portfolio and put it into these kind of trades, but it does mean you can take 20% of your portfolio. Not even 20%, take 10% of your portfolio. That's going to make 60% a year. Put it into a trade like this, and that 10% is going to come back 16%. All right, and you're going to make 6% using just 10% of your money. You don't need to use all your money. You just can use a tiny piece of it to make some aggressive trades like this. And this trade's not even aggressive. This trade is really mellow. This is a mellow trade. This is like, holy crap. So let me get this straight. I'm paying net $7.65 for an 11.50 stock. I'm getting like a 40% discount on the stock. I make 30% as long as the stock doesn't drop more than 10%. Where's the problem with this kind of trade? Why do you need to be greedy when there are trades like this around? I mean, it's all great to have these trades, and you look at Apple, you say, oh, Apple's going to go up 30 more percent. I don't care if Apple goes up 30 more percent. I'll make money. I'll make the same money with this trade. I'll make 30% with these guys in 6 months, tying up so much less cash, you know, with so much less worry. All right, there are in fact some better trades out there. You know, you can find stuff that's a better use of your money than putting $115 into Apple and hoping it goes up to 140, which is what crap. It's only 25 bucks. You can make 20%. All right, if it pulls back, then what do you got? Nothing. If this one pulls back, I get 30%. That's how you got to choose your positions. And it's so much easier to find these things when you're back to cash and you start making a new watch list and a new buy list for yourself, and you watch another 10 stocks and you find the ones that get cheap. And the real benefit of like our chat room and talking about this stuff every day, because it wasn't my idea. I forget who brought it to us, but you know, somebody had this idea for approach, and it was like a great one. I looked at it and said, "Wow, that's freaking great." I'm like, that's a fantastic, just happens to be a fantastic setup to put this in play. And if you look now, it's actually the same price. I mean, today it's quoting out the same as it was. We only did it like 2 days ago or last week. It quotes out right about the same price right now. It's just amazing how things like this just sit there and you can buy them. All right. Let's see what else. So where were we? Oh yeah. So these guys. So you know, yeah, boring. It's 25%. So that's the only reason we haven't cashed the short-term portfolio is we got to protect this ridiculous gain. We have a $130,000 gain for the year. You know, you kind of want to protect that. So we did sacrifice the short-term portfolio, but it's still up 70%. That's pretty good considering we expect. Normally, we should be losing money. We should have lost probably $25,000. I wouldn't, you know, in reality, the short-term portfolio should be down 25%, because the idea, in a flat market, the idea to start out with is just to hedge the long-term portfolio. What happened is we happened to be lucky. We picked a few good trades this year and made some nice winners, you know, and that's what we do. You know, the primary thing we start with in the short-term portfolio is we set up hedges. So the more bullish we get in the long-term portfolio, the more bearish we get in the short-term portfolio. But here's where it gets tricky. Since we have all these bearish bets in the short-term portfolio, there's no harm in offsetting them with some short-term bullish plays. See, that's the key. Because what we've done all year long is we said, sure, we've got this hedge, we've got these SQQQs, we got a shitload of them. We got, what do we got, 100 SQQQs, we've got 50 TZAs. So let's do some math. And we got these DXDs, got 100 DXDs. So I got these 22 DXDs. So let's say the market drops 10%. All right? DXD goes from 22 to, it'll go up 20%. So DXD will go up like to 26. And these things will be worth $40,000. They're currently worth $6,500. So they have $30,000 coming from that. All right, let's get my little calculator. I'm going to lose track. So the DXDs are worth $30,000 in a drop, okay? Now, let's look at XRT. Well, XRT, now see, XRT is different. XRT is just a bet. But also, if the market drops, I know I'm going to collect on my XRTs the full $6 here, times 10 is $6,000. What are they worth now? They're worth, what is that? $3,000 or whatever, 36. So let's say it's going to be plus 25. So plus 2,500 for the XRTs. All right. Now my TZAs. This is 4 times 50 is $20,000 worth of TZAs, currently being valued at $6,200. So I'm sorry, what did I say they were? 4 times 20. Is that right? $20,000, right? So currently worth $60,000. So let's say that's going to be 13,500. So 13,500 there. And last of all, the SQQs. We'll ignore fast. That's a different kind of hedge. And then we got the SQQs. We got 100 of these guys. 35. Now SQQ is only a 30, but it's a triple ultra. So if the market drops 20%, these will go up 60%. To 48, these will be $13 in the money. I got 100 of them, and that's, I don't even know, it's a lot of money. It's 130. I don't know why I bother with the other math because it's going to be it's going to be $100-something thousand. So anyway, so let's say, okay, bottom line. So we got about $150,000 worth of hedges here. And they last until June. So between now and June, we have $150,000 worth of payoff on our hedges. Oh, I'm sorry, net of that. So net of 20 here. So $130,000 worth of hedges. So that's how much protection we have. So we actually are protecting our long-term portfolio 20% against a drop. Oh, frick. Are you kidding me? Thanks, Rich. Every time I'm doing this. So we have, we definitely have full protection on long-term portfolio. Now, what does that mean? A, it means we can be free to buy more bullish positions on the long-term portfolio because we are completely covered against a 20% drop. Also, though, it means that since I know if the market goes down, I'm on the road to making $120,000 in this portfolio. That means that I could take some bullish risk because even if the market does go down a bit, all right, and I get my 150,000 there, say 50, 60,000 here. If it goes down, I know that I'm going to, I know I'm going to pull money here and probably more money than I'll lose on the long-term portfolio. It depends. You got to watch your ratios and how they're moving. That's why I always like to add up the two totals. But I probably don't need, it's probably overprotected. So I wanted to take some bullish offsets. Now, what else do I know? I know that the money I put in, 13,000 here, 4,000 here, it's 17,000. And how much am I Qs? And 40,000. So what did I say? 13, 4, 17, and 40, let's say. So about 56, let's say 55,000, about $55,000 worth of hedges. So I spent $55,000 to protect myself $130,000 against a drop. I'm sorry, it's more than that because I'm sorry. spend $55,000, but I would make profit $130,000 if we have the drop. But if we have no drop, then that $50,000 is going to evaporate. So here's the key. Between now and June, do I know for a fact that I'm going to make more than $55,000 in the long-term portfolio if the market doesn't drop? And that's a yes, because we know we aim to make 20% a year on our position. So if the market is flat or up, we will make at least 10% over 6 months, at least. All right? So there's my logic there. So in a flat market or an up market, I'm going to at least break even, or probably do better than break even against my hedges. All right? Now, we have a lot of hedges because we're going into the holiday. I wouldn't usually have this much hedge, but we have a lot because we're going into the holiday, and I want to make sure we stay as neutral as possible. And we are, because if you add these two things together, 170 plus 560 or something like that, we're at like 730, 740. We've been in that range for a long time right now. I mean, the market's been going up and down and sideways, and we keep staying in that range. We're kind of locked in for the holidays with a neutral position. So anyway, so now with my short-term trading, what's my goal? Since I can only lose if the market goes up, I make a bunch of short-term trades that can only lose, that are going to win if the market goes up. Because if the market goes up, I win. If I win 5,000 here and 5,000 there and 5,000 there, I'm offsetting that $55,000 loss. Okay, so that's how we run this portfolio. So within this portfolio, we just try to make a little bit of money here and there on different positions just to offset the $55,000 cost of protecting the long-term portfolio. That's all there is to this portfolio. So like I said, during the year, we happen to have made some pretty good calls that have given us some really nice returns, also including the downside returns. And the thing about the downside is that we've made some downside payoffs. We've cashed in some bearish positions. We've kept the money in this portfolio. We haven't transferred it to the long-term portfolio because we haven't needed it, because every down move has bounced back this year. There's been no need for the money in the short-term portfolio to go to the long-term portfolio to buy more stuff. So that just hasn't happened. And look at the S&P right now. It's never going to happen. Oh, son of a bitch. All right, well, I should have stopped that line and said stop. So that's that. I don't know if anybody has any questions on that stuff, but that's the goal of this portfolio. It's very simple. It's all a balancing act. It's like the main balance is on the seesaw. You have one end, you have the long-term portfolio. On the other end, you have the short-term portfolio. Right now, they're really, really even. But within the short-term portfolio, you have to balance out your primary hedges with some trades that are going to make money in the short term. And so what are we trying to make money on? It's not always a long. Like we took, now we're wrong about these, unfortunately, but we took a Baidu short, we took an EWJ short that's so-so right now, GMCR short. We took a few positions we just think are going to work. We have this complicated fast trade that does really well over time. It's a pain in the ass to manage, but it really does very well for cash. We have a bullish position on Silver Wheaton. We have this Tesla spread that's I guess it's bearish. Yeah, it is bearish. We have this, well, no, it's not really bearish. I mean, it's sort of an in-between. We sold the calls, we sold the puts, and it's coming in between nicely. That's a good position. I mean, that's $18,000 there on this thing that we can make. And ultimately, I think we will make $18,000. We have the bullish USO and we have the bullish Yahoo. The bullish Yahoo is a substantial position. That's going to pay $21,000 when it's full, and we netted into this trade for it was a net what's that? That's 21. So basically, I think we spent $3,000 and we get $20,000 back out of it. That's a great play. But that's how we offset, because we were like, well, we're bullish on Yahoo. We thought that Yahoo was going to do good because of Alibaba. We took up this bullish position. It's like super in the money now. And it was an offset, though. How do you figure out what you can make on your spread? Well, that's easy. I mean, look, it's how much will I make on the spread? If this works out, this expires worthless, so that's zero. These guys are going to be $7. That's the amount of the spread. $7 times 3,000 is $21,000. So there's that. So I know I'm going to get back $21,000. How much did I spend? I spent $24.50 minus $12.3 minus 9. So that's $21.6 less $24.50, around $3,000. So that's how much I'm going to make on the spread. I'm going to make $21,000 minus $3,000 is $18,000 profit if Yahoo stays over $39 through April. Okay? And that's why, though, I was banging my fist on the table for that trade over and over again, right? How many times did you hear me say, this is a fantastic trade? All the way up to the Alibaba IPO. I was like, this goddamn, even after the Alibaba IPO, because Yahoo didn't move that much. And I kept saying every day, I swear I must have mentioned this trade 100 times. I was like, how could this trade not work? They own more Alibaba stock than Yahoo is worth, or was worth. Now it's being valued a little bit. But at the time, they own more stock in Alibaba than the whole company of Yahoo was being valued at. They've given Yahoo a negative valuation, basically. Even though Yahoo is a perfectly good company that makes money. They might not make as much money as Google, but they make money. There's nothing wrong. Yeah. Now, I don't say there's nothing wrong. When you say a lot of things are wrong with them, but the bottom line is they're making money. They're doing well. They're a nice little web company. They're not kicking ass. They're not taking names, but they're a good company. So why would you value them like they're beyond worthless? It's ridiculous. But this is our job, right? This is what we're supposed to be doing for a living, not waiting to see what's trending higher. That's not where the money is. The money is in identifying underpriced, undervalued stocks or overpriced, overvalued stocks. But the idea is to find things that are mispriced, that you can take a stand on over time and say, I expect this to go up, I expect this to go down. And if your premise is correct and it plays out, you can make a fortune. I mean, to me, it's like to make $21,000 back on $3,000. We did the spread in 9/23. It's not even a year. It's not even 9 months in the end. I guess it is right about. No, it's not 9 months because April. I don't know how many months it is. 3 plus 4 is 7. There you go, 7. So in 7 months, to make 7 times back on your money, you're basically making 100% per month on this trade. That's what this trade does. You're not going to make that with a stock. You're going to make it with a premise. And you'll find them if you spend more time looking for things like this and less time staring at a portfolio full of crap that you don't quite know what it's going to do. You understand what I'm talking about? In other words, if you have 30, 40, 50 positions and you're always worried about, I don't know why it's going up, I don't know why they're going down, I don't know what happened today, I don't know why balance is, I don't know what this move is going to affect the market, then what are you doing? You spend your whole day putting out fires. This trade, we put in our portfolio, and other than me having to tell people not to worry about it for the first month or two, because everybody's freaking out that it wasn't doing well, it's a set and forget. Because it was so ludicrously undervalued that I was like, there's just no way this is going to lose. Now let's see. I mean, look at Yahoo. We brought this in, what, September 23rd. So here's us, September 23rd. Okay, we bought it here. I said this was silly. It did good for a few minutes, and then it went way down here. And everybody freaked out. Right before the Alibaba thing, everybody's freaking out, saying, well, what do we do? This trade is not working, blah, blah, blah. It's only testing the 200-day moving average. Okay? Plus, they had Alibaba. It was stupid. I didn't care if it was down here, I would have doubled down. I mean, there was no reason that it should have been there. So what happened? The Alibaba IPO comes in. I think it's probably here where it gapped up. And it's just been up and up and up. So you have to recognize the value of what they have. You have to, at some point. And that's like this Baker Hughes trade we're talking about today. So, you know, if you're kicking yourself that you didn't do the Yahoo trade, you got to look at this Baker Hughes trade and say, well, you know, maybe Phil's making a point here. How the hell can they lose? All right, and the Baker Hughes trade, my numbers. Well, okay, so in fact, that really does have to go in long-term portfolio. So I'm going to officially say right now we're going to put 10 of those in the long-term portfolio because I would feel stupid not including. So this Baker Hughes trade, we're going to agree to buy $55,000 worth of Baker Hughes. About 1,000 shares. We'll do 10, so we're going to agree to buy $55,000 worth of Baker Hughes. And we can afford it because we got $1 million of buying power sitting on the sideline. It's a relative risk. So we're going to do that, but we're going to collect $4,500 for that. We're going to then buy $6,000 worth of those spreads. And if all goes well, they're going to pay us $11,000. All right, so we're setting aside, we only really have to set aside $2,500 because our net on the spread is, our net on the trade is $56.50, so it's $23,000, I'm sorry, $28,000. That would be the net cash that would be used in this transaction because of the margin. No, it's not a bang my table trade. If it got cheaper, it would be, but it's not. Okay, the Yahoo is just ridiculous. This is only extremely interesting. But it's a similar trade. What I'm saying is it's a similar logic because it's a the math is in your favor and strongly in your favor. And you have to look at it also and say, well, Baker Hughes isn't a terrible company anyway. They weren't even up on takeover rumor. It was just weird. They just sort of they were falling. They became a good, attractive price, and that's Halliburton's logic. Halliburton's saying, yeah, we think they were fairly valued in July, and we think that the energy market will come back, and that this will be a good price for them again. So we want to buy it because if they had offered them $75 in July, Baker Hughes would have laughed at them. But by offering, for the whole company, they're doing it now. Christy's asking, if the dollar question, I think I missed your dollar question if you had one. Is the U.S. dollar being manipulated to go higher, and if so, why? It's not being, no, it's not being manipulated to go higher. It's being manipulated to go higher by other central bankers who want their currencies to be weaker. So the euro wants to be weak because they want their exports to do well. The Bank of Japan won't put up with that crap from the euro. They want their currency to be even weaker than that, so their exports will do well. The only guys who aren't pushing their currency down at the moment is us. So therefore, the dollar goes higher. Not because we're doing anything. It's because other countries are doing stuff to make their currencies weaker. And it is all about the exports. Now, we don't really export that much. So we don't necessarily care. And in fact, because we have a very big import economy, we kind of like it when the dollar is strong. It's actually good for consumers when the dollar is strong because they have to look. I mean, what do you have? Turn over anything you have. What do you have that comes from America? Look at all the stuff you have around your house, your clothes you're wearing. Everything except for like the food, basically, is coming from other countries. So we are importers, and so we want a strong dollar generally. We don't want a strong dollar to some extent. For our multinational corporations don't want a strong dollar because they have to deal with overseas all the time. 60% of their money comes from overseas. So if McDonald's is selling 100 billion euros worth of Big Macs, right? If it comes back at $1.25, that's only $125 billion. But if they sell 100 billion euros worth of Big Macs and it comes back at 140, they claim 140 billion in profit. So would they rather claim 125 billion, or would they rather claim 140 billion? That's what the impact is on earnings from overseas. And our S&P, more than half of their earnings come from overseas. So it negatively impacts their earnings when the dollar is strong. But only the earnings they report in dollars for their U.S. companies, so that's how they do report their earnings. So even though they're not exporting to foreign countries generally, they're reporting their earnings in dollars. And they don't like that. They don't want to look bad. That's what it's all about. Just they don't want to look bad. The reality is, though, for the U.S. consumers, it's much better for their U.S. business, and they help the U.S. consumers tremendously. I mean, nobody's giving us a raise, but at least if we're not going to get a raise, at least the dollar gets stronger, so it buys more stuff. So for the short term, it's good to have a strong dollar. Over the long term, it ships more jobs overseas. That's basically what it does. A stronger dollar, if you're employing people, you don't want to employ people in dollars, because they cost too much. It's also much more cheap. It's also much cheaper for me to employ a guy in euros. If I employ a guy in yen, it's almost free. I can buy 2 Japanese guys for 1 American guy. So there's my decision to offshore. I can buy 45 Vietnamese guys. So you got to look at it that way. It's like, what am I getting for my dollar? If I'm in a business and it doesn't matter where I produce my goods, I'm going to produce them wherever I can get cheap labor. Mick says, I was long Hal equity thinking of just selling half the position and entering the BHI play. Yeah, I certainly would to hedge yourself. I mean, you know, you're getting a little of both. Either way it goes, you're not going to mind so much. I certainly wouldn't want to be just all long Hal. I think, look, they're overpaying. There's no question they're overpaying based on the current market situation. And if oil goes down to 60, people are going to look at this trade like they're insane. And that would be very bad if all you're holding is Hal. If you're holding DHI, people will be saying, oh, thank God we sold freaking stock. So, but they'll both go down because, unfortunately, this is the problem with the stock transaction. It's not a mostly stock deal. It's not a mostly cash deal. It's a mostly stock deal. So because it's a mostly stock deal, if Halliburton stock goes down, it's bad for BHI too. All right. So what's probably going to happen is BHI is going to have some kind of little hassle with the board, and to smooth things over, Halliburton may up the cash portion of it to like $25 or something like that. Won't be a big deal for them. $25 versus $19 is nothing, but it's going to make it at least more than a third cash, and it's going to make the Halliburton, the BHI shareholders feel better about it. That's generally what happens in these sort of situations. But to get the deal done, both Halliburton CEO and BHI CEO both know that the initial offer should be less cash than they'll ultimately offer. Because if you start out at 25, BHI is still going to come back and ask for more. I'm talking about not the CEO, I'm talking about the board, because you can't control the board and the shareholders. It gets once you start selling the company, the CEO's ability to do anything goes down like considerably, because he's basically saying, I'm out. I'm not in charge anymore. I'm selling the company. So all of a sudden, all the shareholders get a lot more power. So yeah, that's right. So what happens is the CEO has to make a deal such that it sounds like he tried to get a good price for cash, but they've got to have something in reserve. Because if you start out at 25, which would be a very sweet deal for BHI, what would happen is the BHI shareholders would come back, they'd ask for 30, and then the Halliburton shareholders would be like, 30? Are you insane? You know, that's how it would go. So, you know, that's how these things generally go. You have to, they play with the cash components, you play with the other component. There's a whole dynamic in play. They're doing this right. The way they structured this is correct, exactly correct for what they're trying to do. But I predict that it will go out at $25 of cash and probably one share of Halliburton, not 1.12 shares of Halliburton. That'll be probably what it restructures to. And that's a good place to leave it. Love this trade, very good trade. We're going to add 10 of these to the long-term portfolio officially. And that's it for now. We'll come back and do it again next week. All right. Thanks, everybody.